A few months ago, I did a video called Pension versus ISA, intended to answer a question I get asked all the time. And lots of you in the comments of that video asked for a slight variation on the theme. So here I am to answer a very important question: which is best, pension or lifetime ISA? Hi and welcome back to the channel. My name is Pete Matthew. I'm a chartered financial planner based here in the UK, and I've been putting up videos on YouTube for more than 10 years, giving you everything you need to know and everything you need to do to secure your financial future. Now, lifetime ISAs are a pretty cool subset of the ISA family, and you need to know about them, especially if you're under the age of 40, unlike me. In this video, I'm going to give you a quick explainer of the rules of lifetime ISAs, compare them to pensions, and then we're going to end up with a kind of do this then that order of operations. Remember, there are chapter markers under the video here, so you can jump ahead if you want to, and if the video is useful, you know what to do. Hit the like button and subscribe if you haven't already. It really helps, so thank you in advance. Okay, so let's look at how lifetime ISAs work. By the way, I just can't bring myself to call them leases or LISAs, so I'm going to stick with lifetime ISAs if that's okay. And lifetime ISAs have been around since April 2017. They are limited to £4,000 per year subscription, and that foreground is part of the overall £20,000 limit for ISAs per person per tax year. Lifetime ISAs can be in cash or stocks and shares form. You have to be under the age of 40 to open a lifetime ISA, and you can only pay into it until age 50. And they are designed to help people save for a house deposit, primarily. And to that end, whatever you pay in is made up with a bonus at the end of the tax year of 25% of whatever you've paid in that year. So if you pay in the full £4,000, you will get a bonus of £1,000 to make it up to £5,000. Now, you can only withdraw your money from a lifetime ISA in 3 circumstances without paying a penalty. One is to buy your first home. The value of it has to be less than £450,000. Or you can wait till age 60, and then you can withdraw your money without any charge. Or thirdly, if you're unfortunately diagnosed with an illness with a life expectancy of less than a year, then you can draw the whole lot out without charge then too. If you draw money out of your lifetime ISA for any other reason, you will pay a 25% charge. Importantly, this isn't just paying back your bonus, it's 25% of the whole pot. So if you put £1,000 in and you get a £250 bonus, and then you draw the money out to blow on a weekend at Barry Island, you will pay 25% of £1,250, which is £312.50. And that takes your pot down to £937.50, which is less than you put in. Having said that, the government did set something of a precedent during the post-COVID recession when they reduced the exit penalty to 20% for a time. But that is, of course, no guarantee that they'll do that again. Okay, so let's compare them with pensions. And the bonus on a lifetime ISA seems, at least on the surface, to work in a similar way to tax relief on pensions. For example, if you are a basic rate taxpayer and you pay £4,000 into a pension, you'll get tax relief of £1,000. But with pensions, we always think and work in gross terms. So that £1,000 tax relief is 20% of the £5,000 total that you now have in your pension. And that 20%, of course, is the same rate as basic rate income tax. Some other comparisons: £4,000 is the maximum you can pay into a lifetime ISA each year, but with pensions, you can put in £40,000, or 100% of your relevant earnings, whichever is lower. With a pension, you can also carry forward unused allowances from the previous 3 years, potentially allowing you to contribute up to £160,000 in 1 year, but only if you have the earnings in the year that you're making the contribution to justify that. So you might have £160,000 of unused allowances that you could theoretically use, but if your salary is only £60,000 this year, then that £60,000 is the maximum you can put in. And that's gross, of course. With a lifetime ISA, if you miss your allowance, you just don't use it 1 year, well, your allowance for that year is gone. So you need to use it or lose it. You can't carry forward unused allowances from previous years. You can't access pensions without penalty before age 55 currently, and that is rising to 57 from 2028. So that's a little bit earlier than the lifetime ISA. The access limit is going to be state pension age minus 10 years. So if your state pension age is 68, then your personal pension access age will be 58. When you take money out of a pension, you can take 25% of your accumulated fund out as a tax-free cash lump sum, and the rest can be taken out all at once, or you can drip it out over many years. But whatever you take in any tax year over the tax-free cash allowance is added to your other income in the year, and you will pay income tax on it at whatever rate you end up at. Now, I did a video a couple of years ago about how income tax works, so I'll put a link to that up here and in the description. Of course, when you take money out of your lifetime ISA, as long as it's either for that first home purchase or after age 60, then there's no tax of any kind to pay. So which is best then, a pension or a lifetime ISA? Well, let's try and put some numbers on it, and I'm just going to scooch a little bit over here. Let's assume that someone aged 25 opens a pension and a lifetime ISA and puts £4,000 per year into each. I'm not going to factor in employer contributions into the pension yet. We're just assuming the same money goes into each pot. I'm also going to assume a return of 5% per year on the investments. These are stocks and shares investments, remember, and that should be an achievable return over time. Well, each £4,000 contribution gets made up to £5,000, as we've seen, either by the bonus or the tax relief. For the lifetime ISA, this stops at age 50. And as you can see, with the same assumptions applied to each, there is the same amount in each account at age 50. After that, I'll assume that the person continues just putting £4,000 into an ordinary stocks and shares ISA from 50 until age 60. No bonus for those 10 years. Of course, those 10 years of lower amounts does make a difference at age 60. There's £474,181 in the pension, £460,974 in the lifetime ISA. 13 and a bit grand difference over 35 years. It's not exactly a deal breaker for the lifetime ISA, is it? But tax is a huge factor. So assume you take the full 25% tax-free cash from the pension and only pay 20% income tax on the rest because you take it over enough years not to trip into higher rate tax. Well, actually, you'd only be able to spend £403,054 of your pension fund. The rest would go in tax. If you took your pension out all on one day, which only an idiot would do, you'd pay some income tax at 0%, some at 20%, some at 40%, and some even at 45%. Who does that? With the tax-free ISA, though, you'd be able to spend all 461 odd grand of it, even if you took it all out on one day. So that's a pretty clear win for the lifetime ISA. Its flexibility is pretty compelling. That comparison example is a pretty unlikely scenario, though, let's face it. The fact is, a pension and a lifetime ISA do different things. So here are some other things to think about. You get your bonus added to your lifetime ISA at the end of the tax year, whereas with pension tax relief, it's added pretty quickly, usually within just a couple of weeks. And that means, of course, that extra money is growing sooner. And those few months could make a difference when compounded up over decades. If you're employed, you will automatically be joined to your workplace pension, assuming that you qualify based on your age and your earnings level. And better still, your employer will pay in for you. So assuming that £4,000 annual contribution we've talked about is the 4% minimum that you have to pay into a workplace scheme, then you'll also be getting tax relief on that and the employer match of 3%. So actually, you'll have £8,000 going into your pension every year. And you certainly don't need a guy on a YouTube video telling you that $8,000 being invested every year compared to $5,000 is going to do better. If you're a higher rate taxpayer, then the maths is even better, as the $4,000 you put into your pension gets made up to $5,000 and you get a further £1,000 off your tax bill. So the £5,000 in your pension has only really cost you £3,000. And if your earnings are just over one of the tax thresholds, then the tax benefits can be even greater. For example, if you're earning over £50,000 per year and you have kids, then you'll be paying some or all of your child benefit back. paying into a pension can notionally reduce your income back down to below 50,000, and hence you get to keep more or all of your child benefit. And similarly, if your earnings are over £100,000, you'll also be losing your personal allowance. Paying into a pension reduces your income back down to that 100,000 and can save you income tax at a notional rate of, get this, 60%. So you see, because the uplift you get when paying into a pension is based on your tax rate, rather than just a flat bonus, as with the lifetime ISA, the benefits are potentially much bigger. And finally, of course, you can put much more into a pension, assuming that you have the income to justify it. Yes, you will be taxed when you take benefits out at the other end, but as I showed in the earlier pension versus ISA video, and I'll put a link to that up here and in the description below, in the vast majority of cases, you are still much better off paying into a pension. So when should you consider a pension and when a lifetime ISA? Well, if you're employed, you should join your workplace pension scheme. That is absolutely a no-brainer. Please don't opt out of the scheme just so you have money to pay into a lifetime ISA. It might seem tempting to do that if your priority is to buy a house, but I urge you not to do it. If you do, you are just leaving hard cash on the table by not taking your employer match. Even if you're self-employed and you don't have an employer paying into a pension for you, I would still pay into a pension first. Maybe try and put 5% of your earnings in. And if you have your own company, pay in from the company and save the corporation tax. So join the workplace pension, pay in the 4% minimum. Then, if you're planning to buy a house in the nearish future, I would absolutely look at maxing out my lifetime ISA allowance. Then, pay the maximum into your workplace pension to get the best available match from your employer. And if you're not thinking to buy a house, or if you already own one, I would actually do that before paying into a lifetime ISA. After that, you can choose whether to add to an ordinary stocks and shares ISA, a lifetime ISA, or increase your payments into your pension, and that decision will depend on your age and your wider life plans. Some may prefer the easier and earlier access of an ISA, others might prefer the tax breaks of a pension. When your income increases, do your best to maximize your pension savings and your ISA savings. The ideal scenario, of course, is to pay into both, income permitting. So here's the bottom line. The lifetime ISA is great if you're looking to buy a house in the near-ish future, your first house. For retirement, a lifetime ISA is an additional option, not an alternative to a pension. So the question isn't pension or lifetime ISA, pension versus lifetime ISA. It should be pension, then lifetime ISA, if you want to buy a house. Okay, folks, hope that was helpful. If it was, you know what to do. Remember to hit the like button, subscribe to the channel if you haven't already, and do leave a comment. I really love to read them, and I try to answer as many as I can. Thank you so much for watching. I will see you in the next video.